Test 1, 2, 3. Good morning, everybody. Call to order for October 8th, 2025 for the Corporate Governance Committee, and call the roll.
Sure. Thank you, Mr. Green. This meeting is being conducted as a virtual and in-person meeting. So I will do a roll call of the trustees to confirm attendance. Mr. Green? Aye.
Present.
Ms. Ginsburg? Ms. Langton? Here. Ms. Martinez? And Trustee Jones?
Present.
Okay, Ms. Me? Ms. Martin? Mr. Gatto? Mr. Ruth? Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, PIO Scott Drazel, and investment, can't remember your title, Pierce Hugh Smith, sorry. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we will proceed with the agenda.
Thank you, Linda. Do we have any 2449?
We do not.
Need a motion for approval of the minutes on May 14th.
So moved.
Okay. Mr. Green?
Aye.
Ms. Langton? Aye. And Mr. Jones?
Aye.
Okay, the motion passes unanimously.
Excellent. Do we have any public comment?
We do not.
Fantastic. We'll go right into item 5, the reports, 5A. None.
Great. Good morning, Chair Green and trustees. Report 5A is presenting for the committee's review the results and trend lines of our proxy voting results for the fiscal year 2025 for both the total fund as well as OPEB. I'm going to go over some introductory contextual comments and information, and then Pierce will dive into some statistics and observations. So by way of background, where LACERA holds shares at public companies, we have the right to vote proxies on certain matters that are presented to a shareholder vote. Fiduciary duty does consider our proxy votes to be plan assets that should be managed in accordance with fiduciary duty and our interests in sustainable economic value. LACERA has worked to retain our voting rights where we contract with external managers. So as you can see on slide 2, we now have voting authority for 98% of the value of the global equity portfolio. And where we hold a company in different accounts, we are voting the same way, consistent with LACERA's own custom proxy voting policies, which are outlined in our corporate governance and stewardship principles. I'm going to jump to slide 4 briefly, where trustees can see that as global investors, we do have exposures in nearly 60 markets, 59 markets. So we voted last year over 6,000 meetings. That includes about a quarter of the meetings that took place at North American companies. And you'll note 34%, even higher proportion, are in Asia. That's because some of the companies in Asia were holding multiple meetings within the same year, sometimes 2 or 3 times a year. Different things are coming up. As the bar chart across the bottom shows, most of the meetings do occur in Q4 of our fiscal year. That's April 1st to June 30th. That's the busy proxy season where companies hold meetings after their year-end fiscal results have been released. So back to slide 3. To navigate the volume of proxy voting and really all of our investment stewardship initiatives, LACERA has developed our own corporate governance and stewardship principles. This policy is divided into 5 sections that cover 5 common topics of corporate governance, such as investor rights, executive compensation, boards of directors. The bottom right pie chart shows the prevalence of the ballot items that come before us, divided by those 5 sections. You can see that every year consistently, really the majority, so 55% of the items pertain to reviewing nominees for boards of corporate boards of our portfolio companies, where we expect accountability. We want them to be significantly independent of company management and demonstrate a compelling record of acting in investors' best interests and overseeing risks. We expect financial reporting to be transparent, to provide credible, comparable, reliable information. And you'll note that while only 1% of items come before us pertaining to environmental and social issues. When they do come up, we expect companies to prudently manage material financial risks, such as their talent management or attending to environmental liabilities. So slide 5 is a quick reminder of our proxy voting process, beginning with step 1, by which any revisions to the principles get considered by this committee that advance to the board for approval. And then in step 3, we jump into action with implementation. We have an online electronic voting platform which routes all meetings to us. We incorporate some general parameters, and we review every item to try to ensure consistency with LACERA's own policies. And at the end of the year, we come before you with the high-level results so that you can see the action. I'm going to turn it over to Pierce to dig into the specific support levels and trend lines by topic. You'll note that as we go through it by topic, we have presented on the left side some information about market statistics, and then on the right side, LACERA support levels, so you can see our support levels in context with the broader market. And you'll note that for every topic, we are generally holding companies to a higher standard of corporate governance practices than the market. So with that, Pierce.
Thank you, Scott. Good morning, Chair Green, trustees. Excellent. This slide details both the volume and support level from 2023 to 2025, based on whether the proposal was sponsored by the company's management or by its shareholders. I'll draw your attention to the chart on the left, which displays the relative volume of management and shareholder proposals. Management proposals account for, as Scott noted, the vast majority of items, despite the high-profile shareholder proposals often attract. Our trend lines for support, shown by the charts on the right, are generally consistent for management items, where we support about 2/3 of proposals. For shareholder items, we support approximately half. And in the coming slides, we'll break this down by topic. Here, we unpack our support for director nominees, which, as Scott noted earlier, represents around 97% of the items we vote. On the left side, we provide an overview of market statistics, which indicate investors are by and large supportive of most nominees, with the average support level for directors being 95%, shown in the dark blue box. Fewer than 2% of directors get less than 70% support. And there's been a greater emphasis in recent years on adding more specific skills to boards and searching wider for directors with those skills, as noted on the left, with over 2/3 of new directors being non-CEOs, 1/3 of directors being first-time directors, and 1 of 5 bringing sought-after skills in tech to boards. Moving to LACERA's track record in 2025 and earlier, our principles have high standards for directors. We emphasize board quality, where we seek directors who have a range of skills and experience that enable them to oversee strategy whilst acting in investors' interest. Consistent with LACERA's principles, our support level for the past 3 years has been around 60%, compared to the market average support of 95%. Where we do withhold support for directors, this is most often due to our principles' focus on director independence, unequal voting rights, failing risk oversight, or an excess of commitments to other boards.
May I ask a quick question for clarification? On this slide 7 here, the 95% and 2%, that is support from the entire voting body. And then on the right is our position, right? So that's everybody. So 2% of directors receiving less than 70% from the entire voting body, correct?
That's correct, yeah.
Okay, thank you.
Thank you. Moving on now to executive compensation. Investors continue to offer high support for executive pay plans. This is the market support shown on the left. Average support is 91%. On the right, we provide LACERA's support levels for executive pay, where consistent with our support for directors, LACERA's principles have a high standard. We support pay for performance that encourages durable value creation and the mitigation of risk. If a large amount of pay is not connected to performance, this is not necessarily in investor interests. LACERA has voted against approximately 1 in every 4 pay plans. This is typically due to poor pay for performance. It may also be due to excessive CEO perquisites or outsized severance packages, commonly referred to as golden parachutes. Moving on to shareholder proposals specifically on governance topics. Average support for governance proposals is 42%, shown on the left at the market level. This is much higher than the average support for shareholder proposals generally, which is approximately 24%. So further to this, companies may also agree to implement practices before an item goes to vote, which prompts proponents to withdraw proposals that would have likely achieved higher support levels. In 2025, LACERA supported roughly half of governance proposals, focusing on items such as implementing an independent board chair, adoption of a simple majority voting, or adoption of a simple majority voting standard. This is consistent with our principles that support shareholder requests for sound governance practices that improve the rights of shareholders.
Another point of clarification for me, and I appreciate your patience. That simple majority vote, we've talked about this before, right? That's where maybe a CEO or whoever started the company might have 3 times the votes per share or whatnot, right? Is that what that is? I forget how we broke it down before, Scott, but
Sure. So so as part of just
weighted vote, yeah.
right, part of supporting strong investor rights, we do encourage each vote to equal each share to have 1 vote. That would be weighted voting. The simple majority vote is similar in that we're supporting efforts by which, if a measure is brought forward for investor approval, we don't want a super majority requirement to take certain actions. That simple majority of investors
50%
should
plus
suffice.
1. Yeah,
Right.
gotcha.
And sometimes these governance provisions, when they're in combination, can entrench management because it makes it more difficult for investor will to be heard and perhaps acted upon.
Right, but that weighted thing, we still gravitate towards trying to stay away from that also.
Correct.
Yeah, okay.
And we'll
Great.
talk about that a little bit more when we get to some of our initiatives.
Thank you.
Sure.
Yeah, excellent. Thank you. Yeah, of course. Thank you, Scott. Other governance requests that we supported just beyond what we've already mentioned typically relate to political spending disclosures, which LACERA tends to support. Where we may not support items, this is typically where the request is overly prescriptive of management and where the proponent's underlying request is unclear. Regarding environmental and social topics, these typically are non-binding requests for a company to provide specific reports or business actions. I want to highlight LACERA's average support of 24% for environmental items and 55% for social items. This is on the right of the slide, these 2 bar charts on the left and right respectively. Turning to the left, it shows that the market average for support for these proposals is 14%, shown by that green box in the bottom left. When we look at environmental and social issues, LACERA's principles ask companies to consider and disclose financially material risks. For context on these support levels, however, it's notable that in 2025, 28% of these proposals were counter proposals. This is shown in the mid-blue box on the top right of the left-hand side of the slide. LACERA's principles do not support these items where companies are asked to discontinue environmental or social initiatives. Rather, we expect companies to prudently manage material risks and support disclosure of risk management. This approach is consistent with most other shareholders. Counter proposals only receive around 2% of support on average. However, their volume is rising. The disclosure landscape for sustainability reporting has also improved over this time after prior investor requests, often made through shareholder proposals, were implemented. Now, 98% of companies provide some sort of sustainability reporting. And finally, I'll note an increasing shareholder focus on artificial intelligence proposals, where investors are requesting boards to provide clear disclosure of what steps the company is taking to mitigate against risks posed to data privacy, copyright infringement, and consumer safety and protections. And with that, I will hand back to Scott. Thank you.
Great. So you can see the landscape on shareholder proposals is kind of evolving a little bit, where a quarter of the proposals this year were really from two groups in particular that were asking companies to discontinue. So that did get a lot of media attention, but we thought it was notable to highlight that 98% of investors were voting against these measures last year. In the interest of transparency, each year we also provide the committee with an operational update, particularly on where LACERA did not vote, consistent with our fund policies. So on slide 7, the committee will note that LACERA does participate in securities lending to generate incremental income. This is consistent with fund policies. Where securities are on loan, we do not have the right to vote, so that impacted about 12% of meetings. That's also consistent with the year-over-year trend lines. We do maintain policies and procedures by which, if we know of a high-profile meeting coming up, we will endeavor to recall shares so that we can take action on those votes when they come up. In addition, fewer than 1% of meetings were not voted due to local market impediments. That includes some companies that require shares to be blocked from trading, called share blocking. We do not want our external managers to be impeded from trading shares in our economic interest. So we will not vote at companies that have share blocking. The good news is that was not very prevalent this year, and I think that that's a result of good efforts by governance associations that we support, like the International Corporate Governance Network, that has engaged local regulators in different markets around the world to say, please prohibit companies from having share blocking so that investors can take action and exercise voting rights when they come up. So that was fairly minimal. And lastly, we note that we review our votes to promote consistency with our policies, and this year identified about 0.2% of ballot items where a vote on an individual ballot item was misinstructed, mostly pertaining to shareholder proposals, and where we have reviewed procedures and reinforced them to maximize that we can vote consistent with policies. On slides 12 and 13, this is the second year that we are voting for the OPEB. We've retained voting rights about 2 years ago. You can see that we voted a similar range of ballots and regions consistent with fund policies as well. And on slide 13, we note that the mix of items, management versus shareholder proposals, and the support levels is generally consistent with the total fund results that we just went over as well. So with that, we'd welcome any questions or comments from the committee.
Cyberspace. You know, the data is interesting, Scott, and I appreciate you guys. I'm gonna try and find it. The environmental social stuff, the 28%. I'm curious. I know it's a global slice, but I'm wondering what the strata is. Is it available in that link that you provided, that you can see like how many folks are pushing this counter proposal, like domestically versus? I know some markets, you know, would possibly generate more, but just out of curiosity, does that Harvard proxy season document show by country, by market?
Sure. The 28% of proposals that were, you know, what we're terming counter proposals, were generated by the same 2 research think tanks in the US. And if I'm not mistaken, really focused on US companies.
Gotcha.
Often there would be quote unquote dueling proposals that another group would ask for companies to continue their efforts to mitigate environmental risk or ensure equal employment opportunity policies remain in place. And those proposals did consistently get more support.
So it's mostly a domestic slice then. And this 28% is an uptick in recent years.
Absolutely.
Interesting. Very interesting. Well, thank you.
Thank you.
Go ahead, Mr. Jones.
Scott, do you, in the dynamics of our voting, are we also kind of voting in blocks with other institutional investors, or do we kind of vote our principles kind of on our own, or with CalPERS or with other institutional investors that might be in the company? Are we also kind of, I don't know, sharing thoughts about the voting of those shares? Just curious from a.
Sure. So we vote consistent with the board's approved principles, but we do collaborate with the Council of Institutional Investors and other investors to try to understand what's going on in the market and what principles and policies, practices make sense. So over the years, the higher standards kind of established by CII, we've tended to be aligned with. And if you go back to the 90s, maybe a slim majority of boards would be comprised of independent directors. CII, LACERA, other public plans really urge that a supermajority of boards be comprised of independent directors. And over time, that's exactly what's happened. In the US, that percentage is 85, 90-some%. Typically, maybe just the CEO will serve on a board.
Mm-hmm.
In other markets, like Japan, the boards can still be majority management. But through collaboration with International Corporate Governance Network, the local Japan Stewardship Code, Asian Corporate Governance Association, there has been an effort to expand outside directors, and we're now seeing maybe 2 or 3 outside directors being added.
That's why the work that CII does and LACERA being leaders in this, I think it's so crucial, to see that. I have one favor to ask, if you could email the committee. I'm very intrigued by this counter proposal dealing with ESG and whatnot. Is a simple chart showing a trend line? Like you said, there's been an uptick. Would you be able to produce something? Don't spend too much time on it, but.
Sure, we can provide a quick follow-up for you.
Okay, that'd be great. Yeah, appreciate that. Send it to the committee. So, anybody else? Thank you.
So with that, we can go to report 5B if it suits the committee. Great. We'll just
Sorry,
ask
Scott,
our colleagues to bring up
Sure,
the
you
next
just flow
report,
right into
please.
it. Yeah.
Great. Thank you, Melissa. Great. So report 5B is also it's also provided for the committee's review and covers our key corporate governance and stewardship initiatives. We'll go over a summary of engagement initiatives where we go beyond proxy voting to proactively encourage portfolio companies to adopt practices consistent with LACERA's principles, as well as engaging policymakers. We'll cover a brief update on the fund's efforts to consider material ESG factors in our investment due diligence. And lastly, we'll highlight how we've continued to try to avail some public information, public reports, so that members and the public know what LACERA's stewardship efforts are. As slide 3 notes, all of these initiatives are guided by the board-approved stewardship principles, with really that exclusive aim of promoting sound corporate governance practices at portfolio companies and in financial market policy that hopefully protects our investments and helps them grow over time. I will start with the first section on engagements and policy advocacy. We're on slide 5. You can see a summary of the 4 key themes of where we pursue engagement and advocacy. It includes weighing in on proposed public policies and regulations that might impact investor rights or market transparency, what companies are required to disclose to investors, for which we are often collaborating with Council of Institutional Investors and other funds, as previously mentioned. Continuing clockwise, we also engage portfolio companies on a defined set of thematic initiatives where we think we can credibly and constructively work to try to advance systemic adoption of practices in line with LACERA's principles. That includes encouraging corporate boards to focus on skills when they're going out and recruiting and cast a wide net, inclusive of diverse backgrounds, energy transition, and again, as previously mentioned, investor rights like equal voting rights that we'll cover in turn in the coming slides. In the bottom left corner, we've been supporting industry efforts to expand the quality and availability of information that companies disclose about different sustainability risks, be it their labor relations practices or environmental considerations. And we do that so that that information can be used in investment analysis by us, by our external managers, or by the market, so those risks get better kind of priced into the market. And lastly, where practical, we endeavor to advance thought leadership, such as our total fund approach to LACERA Tide, which we will cover later in the year in a total fund update. Throughout these efforts, as noted across the bottom, we are guided by fiduciary duty and financial interests. So we endeavor to focus our priorities on where we can be credible and speak as investors with a vested interest in the company's success, of course, not as outsiders. We try to make responsible use of finite resources and focus efforts on where improvements at one company might have spillover effects and lead to market adoption of better practices, as we just discussed with the expansion of board independence. With that, I'm going to turn it to Piers to cover the first couple of initiatives.
Excellent. LACERA has been engaging corporate boards on board quality and diversity now for 7 years. And in the principles, we encourage boards to identify the requisite skills and cast a wide net in their identification of candidates to ensure that they provide prudent risk oversight and steward investor interests. We believe that constructive engagement can prompt firms to open up their recruitment process beyond their immediate networks. And overall, this has resulted in engagement of 235 distinct companies over this 7-year span of the initiative. 41 of these companies were in 2025. Of those companies, the 41 in 2025, they have appointed 31 directors of diverse backgrounds, and across the entire 7-year engagement, the engaged companies have themselves appointed 478 directors from diverse backgrounds. Looking ahead to 2026, the initiative will engage 47 companies, of which 34 are in the United States, and the remainder are in Japan and Brazil due to our significant portfolio exposure in those regions. Moving on from board quality and diversity, proceed to equal investor voting rights. LACERA's principles support equal voting rights across all shareholders proportional to their economic interests. So in other words, for every single share owned by an investor, there should only be one vote. And to support market practice that embodies this principle, LACERA is a member of the Investor Coalition for Equal Voting Rights. This was co-founded by the Council for Institutional Investors and represents around $4.5 trillion of assets under management. Dual class structures may diminish investor interest through reducing the accountability of management and through discounted share prices, which we typically see manifest around 5 to 7 years after the IPO has taken place. So in the past year, the initiative has met with investment banks and private equity firms to encourage them to support the adoption of equal voting rights by companies they are bringing or assisting in bringing to an IPO. Progress on these items is positive. Around 90% of US public companies currently do utilize an equal voting structure, and around half of recent IPOs that are dual class have adopted a sunset provision which removes this structure after a reasonable time period. With that, I will hand back to Scott.
Hey, Scott, I got a question. So this weighted voting thing, if we look at it, is there a financial interest advantage period to it at all? I mean, I know I can kind of see why founders potentially want it, but have we had enough time to look at it to determine whether there's some performance benefit during the period for which they have it after the IPO, or, and that kind of ties into the 7-year sunset provision. Have we determined from a data perspective that after 7 years, basically we've squeezed about as much performance as we could out of that arrangement? Or is it just a concession to say, founders have had enough time to kind of control post IPO. Now it's time for more traditional management. I'm just curious what the kind of thinking is around that.
Do you want to speak?
Yeah, I'm happy to.
Come in afterwards.
Excellent, thank you, Scott. Yeah, so these structures typically don't offer an economic benefit to the shareholders who don't have them. So the economic upside is really limited and captured by the controlling shareholders, and it may allow them to emphasize that concentration of value given their rights to be able to force items through.
Okay.
There's we're diversified, right?
Mhm.
Across a lot of thousands of different companies. So people will inevitably raise, well, what about Berkshire Hathaway? What about Meta? They're dual class and currently performing fairly well. I think what Pearson, the research highlights in the slide, is that overall there can be a tendency for a discount in share price. And since we are diversified, that's part of the reason why we would encourage investor rights that are conducive to better pricing. There's also the risk of what can go wrong when a company like WeWork implodes and investors have no recourse at all through investment rights, and a company like Meta, where there are repeatedly shareholder proposals that are receiving a majority of outside support, but the company can clearly disregard because of the controlled voting rights. So that's part of the effort. And the sunset provision, based on 5 or 7 years, that tends to be where things trail off. So in the discussions with private equity firms, private credit, there's a recognition that if you want to maximize the pricing at exit, might be best to have the strongest possible investor rights in that IPO.
I'll just briefly add as well that dual class typically it does not stand alone as an issue, and many of these boards will then have other inconsistencies with our principles around independence. So it tends to correlate with other governance items that we emphasize.
Great. Moving to slide 8 then. This covers updates on a global investor initiative on energy transition and climate risks, through which LACERA is supporting an effort to engage 168 of the most carbon intensive companies to encourage them to disclose how they're navigating the energy transition to support long-term shareholder value. These companies, as noted across the top, represent 80% of global industrial emissions and about 50% of LACERA's measured carbon footprint. So by engaging a concentrated number of companies, we're working with a significant segment of companies responsible for our carbon footprint. As we note here, 90% of these firms now have board oversight to look at assessing risks related to their business practices and how they can navigate through an energy transition. Most have plans in place to reduce emissions intensity, and over half have disclosed capital spending plans that align with their stated goals. LACERA participates in discussions with companies in the US utility sector in particular, whereas noted on the right side, 22 out of 29 utilities, so most companies have reduced their carbon intensity as the energy mix evolves. And we are encouraging companies to have clarity and consistency in their forward-looking capital expenditures so that investors can price risks and their forward-looking business plans appropriately. Slide 9 covers our a few of the efforts that we're supporting to try to facilitate clear, consistent, comparable information about companies' sustainability risks, to understand how they're managing those risks, where they're material to their industry and their business prospects. On the lower left side, you can see that 90% of large US companies are voluntarily providing information now consistent with the International Sustainability Standards Board. About 75% of companies outside the US are subject to mandatory reporting requirements from local financial regulators or their stock exchanges to provide information consistent with ISSB. ISSB standards are focused on the material risks that are specific to 77 different industries. So a mining company might have to report on workplace safety, whereas a bank reports on data privacy measures, what's more relevant to a different business. And we are participating on their investor advisory group, whereby in the last year we have sent comment letters to local regulators if they're considering revisions to local market reporting requirements. We encourage that those requirements align with the ISSB so that companies and investors don't have different frameworks in different markets. It facilitates comparability as well as reduces reporting costs and burden on companies. On the right side, we provide quick updates on 2 reporting initiatives in private markets, where LACERA supports the Global Real Estate Sustainability Benchmark, and our reporting managers in our real estate portfolio have generally outperformed peers and demonstrated some year-over-year improvements. And more recently, as trustees will recall, LACERA affiliated with the ESG Data Convergence Initiative in August, where 60% of our private equity partners have started to track and report on core metrics such as workforce turnover and injury rates. So as these initiatives expand, again, our aim is to try to avail quality information that can be used in investment analysis and monitoring. Slide 10 covers some of our policy engagements, each of which has previously been reported to the board. It includes submitting comment letters to the SEC that recently asked for market input on the effectiveness of executive compensation disclosures, as well as some of the recent activity globally on refining and developing sustainability reporting requirements. In the US, we are definitely watching for some increased regulatory proposals around disclosures and reporting effectiveness and investor rights, and in conjunction with CII and others, will be positioned to comment on those in line with the principles and policies outlined therein. So the next section is going to focus on our efforts to consider ESG and fund due diligence and portfolio construction here. LACERA, as trustees know, conduct upfront investment due diligence of any firm that wants to manage capital on our behalf, on to what extent they're identifying and managing financially relevant ESG risks. Each firm is scored on a 5-point maturity scale, which is illustrated on that upper right side, with firms that have more systematic, well-resourced, and compelling approaches scoring generally higher. These scores are available to the board in quarterly performance reports and the manager scorecard. Across the bottom, we've summarized a bird's eye view for the committee of each mandate and each asset class. This includes every current manager. So the higher stacks in private equity, for example, really account for just the larger number of mandates in that asset class compared to others. You can see that over time, there's been a steady and increased sophistication in managers to consider and report on material ESG risks that continues to evolve. While some asset classes like infrastructure, real estate, have had comprehensive approaches for a while, we are seeing additional private market asset classes develop more tools, resources, reporting to become more sophisticated on ESG. And we track that in a hopefully earnest way to see what the evolution is. Quantitative strategies have not at this point developed many tools to analyze ESG, but there too, we hope that our efforts to encourage good disclosure of ESG practices could become an opportunity then for our managers to incorporate that information and consider ESG going forward. These scores I want to flag are not a litmus test of whether or not we invest necessarily, but rather are taken in conjunction with holistic investment due diligence on fees, past performance, so forth, to try to consider which firms are best positioned to manage and protect our capital if we were to award them a mandate. All right, heading into the final stretch here, LACERA became a signatory in 2008 of the UN affiliated principles for responsible investment and reports every year on our investment practices, how they line up with those 6 principles laid out on the lower left side. PRI then presents an assessment of how we score in specific categories in comparison with other peers and in comparison with their kind of reporting framework. Here too, I would flag that LACERA is not managing our portfolio to attain specific scores and so forth, but the assessment can be perhaps a tool and quick insight on how LACERA is comparing to some core principles as well as to peers. And on the right side, in those dark blue boxes, you can see our scores are generally high, and those purple lines denote peer practice, where we're above peer practice in pretty much every category. Lastly, on slide 15, we've presented that we're endeavoring to be transparent on our stewardship efforts so that members and the public have a clear access to information on our approach. 2025 stewardship update is included in the committee materials as attachment 2, and that's also available on LACERA.gov. And I know we make use of that throughout the year when people ask various questions. So hopefully that's part of our efforts to expand clear information on LACERA's investment process. And separately, we are posting every comment letter to a regulatory agency on LACERA.gov under recent initiatives as well. I'm going to just flag as well that in the appendix, we did include a note that from time to time we get outside parties approaching LACERA through various vehicles, by email, by phone call, so forth, about different matters related to stewardship or responsible investment. We've established a protocol that's been reviewed by the board previously and as part of trustee orientation, and typically we include every fall as we go over our program review, by which if we are getting information and requests or inquiries from outside parties, we ask that those inquiries be directed to the CIO, who then coordinates with any relevant asset class to look into the facts and the details and the context. And to the extent that we assess in any action, we want to make sure that we're doing so consistent with the Brown Act provisions, as well as any contractual obligations we have as a limited liability partner in some of our private market funds. So if you have any questions on this protocol, please do reach out and we're happy to go over it. With that, that concludes our comments. Welcome any questions.
I have a question. Thank you so much. Both of these were excellent presentations. Going back to dual class, so are Class B shares the shares that founders keep for themselves, or does it not? Is it different per agency?
It depends on how the charter defines it. It could be Class A, Class B, Class C.
Okay, and then is there a standard amount that they keep, or do they get to decide if they want 10 or 20 votes per share per company also?
Sure.
All of the parameters of how the dual class share structures is at the company's discretion. Typically, often we'll see 10 shares per vote, but it could be any.
Got it. Thank you so much.
I just want to compliment the staff on putting this together. This is really good. I enjoyed reading the attachment to kind of the longer narrative that kind of ties it all together. The other kind of tangential question a little bit. So when we complete this, do we make a big deal about it? I mean, do we send out a press release? Do we post about it, or does this kind of quietly go on to the website? And then if you're acutely interested, you might stumble across it kind of in that way. And if we don't, maybe ring the bell on it when we complete it. Because to me, and I think about all the conferences that I sit in and then the conversations that take place around it, I would just think, similar to our TIDE program, this is a pretty comprehensive look at how the board, in conjunction with staff, in conjunction with our managers and partners, how we attempt to kind of administrate the stewardship program. So I just didn't know how institutionally we felt about ringing the bell as we complete a cycle on this versus, hey, it's there for you if you really want to find it, type thing. I mean, can you comment on that at all?
Sure, we do have it on the website, and I think we're happy to discuss with colleagues internally in the appropriate departments on if there are additional avenues to make sure information gets out to the right folks.
What's the website for inquiries? Mr. Grable? New opportunities at LACERA.com, right?
I didn't mean it from an opportunities perspective. I just meant it from a governance perspective, just kind of our posture and our program. As I look at our timeline from 2001, the sequence of votes, the affiliations that we made. I mean, all of that. I mean, I think that's a worthwhile piece of our community engagement, investor kind of community engagement that's there. I just don't know. I get the benefit of seeing it because you bring it once a year, but I just don't know from a more external perspective, do we attempt to kind of, make a little bit more noise around our posture on it or not? Or do we like to keep our head low? I don't know what that is. Yeah.
Through the chair, good morning, trustees. I think that it's an important discussion. I know from my perspective, I think that the work done by Scott and Piers is outstanding. It's something that we should double underscore. I know I sometimes say period, full stop. This is a double underscore in terms of the quality of that there are organizations out there with teams of dozens that don't do as good work as there's a lot of productivity and efficiency. I think that there's a deeper question where, and maybe this is more a question for the executive office. Sorry, executive office, to put you on the spot. I think much of our PR efforts are reactive as opposed to proactive. And I think that we historically have not had a strategic PR initiative within the investment office. And it's something that I know has been asked in the past, but I think that this is more a question for Lewis. And maybe I'm kind of editorializing my thoughts, but it's a great question for Lewis.
No, thank you to the chair and appreciate Mr. Grable. No, your questions are spot on, Trustee Jones, in terms of our posture externally. We are making strides, if you look at some of our social media channels, to really elevate the messaging that we have around LACERA, whether it's our strategic initiatives, our member focus. I think this is an area that we can improve upon. I know we have, in the coming months, we're going to be talking about an RFP for our public relations and media relations. So I think that's an area of focus for us in terms of gaining some insight, but that's certainly an area that we can collaborate with investments. We've added a new feature in our newsletter, kind of an investment corner that highlights some investment related information, but definitely there's an opportunity to kind of underscore some of the important initiatives that the team is working on that we can highlight more broadly.
No, good. Nice. I appreciate that.
Yeah. We do need to plug that website. That's crucial when you're being impacted. Thanks for doing that, by the way. A couple things, quick questions, Scott. The legislative push for CII at the federal level for implementing legislation for the sunset provisions nationwide. Where's that at?
Generally speaking, the market pickup of sunset provisions has been more voluntary basis. There have been proposals put forward with sponsorship in Congress, but they have not necessarily come to fruition or a vote at this point. But it is a multi-pronged effort.
Died in committee, right? The other thing, yeah, I mean, this is great. I mean, Mr. Grable alluded to it, being at the forefront of this, it produces, good governance when everything associated with it produces more back to the fund. The data it shows it. I scanned through the what is it, Virginia Law Review. And it's a very fair article. I mean, they bring both sides of the story about like, dual class stocks or whatnot. They present the why, and there is some larger companies that still have a healthy share, but they've reduced over time, and their value is just increasing and over. And in their conclusion, just to, and why what the work you're doing and why this is important, for all this stuff with proxy voting, and it all is connected. They come in, they say, bear with me, I lost it. I still haven't figured out how to highlight on this thing. Gina showed me. Anyway, I'll just summarize it. It basically says that, having equal voting rights, in perpetuity, dual class voting structure does not work. It pays to have everybody participating in the process. So, and I appreciate you including those hyperlinks in there. That was really good. So, yeah. So, yeah, thank you. Thanks for the presentation and the work. Excellent presentation.
Yes.
Moving on, we've got items for staff review. Any additional comments from the staff or anything on it? No? Go to item 6, please.
Nothing.
Okay. I did say
Oh, wait,
yes, Scott, if I could.
for the graphs.
Yeah, just on the counter proposal.
We'll circulate some
Yeah,
information. Sure.
is it just something simple? I mean, if you got the data. Future agenda, item 7.
Nothing.
Anything? All right. Good in the order.
Nothing. Nothing.
Other than go Dodgers.
I'm glad to be here. All right, motion to adjourn, please.
Yeah.
Okay.